Hello everyone, this is Crypto Bit Law. Today is Monday, January 31st, 2022, and today we're going to be giving an overview and an analysis of the Unhosted Crypto Wallet Rule. But before we dive in, if you like this content, please hit the like button below. Please also subscribe to our channel. That would really help us out as we're seeking to grow and expand our content in the future. You could also follow us on Twitter. Our handle is at Crypto Bit Law. So with that said, let's just kind of give a brief overview of what the Unhosted Crypto Wallet Rule is and the implications of it. So as we can see here, this rule is essentially it's a governmental attempt to apply traditional banking standards to cryptocurrency and digital assets. And the effects of it are a potentially burdensome compliance schema. So it would be costly for entities that are affected by this rule to actually engage in the compliance necessary to essentially comply with this rule. It also threatens innovation because it makes it more burdensome for companies to actually act. In particular, it could affect innovation in the DeFi space. And as we do our deeper dive in, we'll see how that would play out. And then it also raises some privacy concerns. The rule calls for certain disclosures with regards to identities of individuals within certain thresholds of transactions. So with all that said, let's just do a deeper dive and sort all this out and really unpack everything that there is behind this particular rule. So starting here with the Block Crypto, they reported earlier on this month, just some basics regarding this rule and what it is. And as we can see here, it says that at its core, the rule is an attempt to apply traditional banking standards to the cryptocurrency ecosystem. The issue many critics raise is that crypto is, as a technology, different from traditional systems, and curbing the ability to anonymously transact or transact with decentralized entities could limit innovation. The rule itself centers on what FINCEN calls, quote, unhosted or self-hosted wallets. The crypto industry tends to interpret this as wallets unaffiliated with a centralized entity like an exchange. That's also how the Internal Revenue Service breaks down its regulation between exchange-hosted and non-exchange hosted. If the rule takes effect in the coming weeks, it's possible that the decentralized finance DeFi ecosystem could suffer in the short term, since it remains unclear how KYC, know your customer measures, would work when one is sending money to a protocol rather than a person. As larger exchanges attempt to get up to speed with the new compliance standards, which would require new structures of reporting and identity confirmation, firms may freeze certain activities to such wallets or decentralized entities until a compliant KYC system is in place. Representative Warren Davidson, a member of Congress's Blockchain Caucus, said he's worried that the rule could limit potential use cases for distributed ledger technologies. Issues of money laundering and illicit finance abound in the traditional world as well, said Davidson. So there's little point in regulating the new look according to the rules of the old. Quote, it's an effort to try to make digital assets conform to a system that frankly doesn't work that well already, he told the Block. With the proposal came an unusually contracted timeline of 15 days. So-called, quote, significant rule changes sport a 60-day public comment period, according to FinCEN's guidelines, except in the case of emergency necessities. The Administrative Procedures Act, the APA, requires federal agencies to conduct a comment period that's open to the public before any rule is set in stone. Still, despite the shortened time period, stakeholders have managed to submit more than 5,000 formal responses. The regulations.gov website counts 5,633 comments tracked as submitted as of January 4th. So, touching on the APA Administrative Procedure Act requirements, whenever you have new proposed rule changes within the administrative state, so you have pretty much the executive branch is at the head of all of these administrative branches. You have things like, the Treasury and the EPA, the Environmental Protection Agency, all of these different branches of the administrative state that the president ultimately sets policy for. And so when the heads of these different administrations propose significant rule changes, this Administrative Procedures Act, the APA, sets out guidelines for how that is actually supposed to play out. And in particular, it calls for a comment period where people can chime in and give their opinions regarding these potential rule changes so that the government can kind of get feedback on the policy and how it's affected by popular opinion. And so one of the issues here is a traditionally shortened comment period. I think it's normally about 60 days unless it's in a case of an emergency. And we'll do a deeper dive into that as we dig deeper and unpack this a little bit more. So now that we've gotten a general overview of what this rule is, we could see here from this CoinDesk article that was reported a few days ago. It states that the Unhosted Crypto Wallet Rule is back, and the rule was first proposed by a U.S. money laundering watchdog in late 2020. So we had the first proposal, and then earlier on this month in January, it started kind of drumming up more awareness with this blockchain caucus as the administrative state was seeking to move this through, but now it's actually coming to a head. It's actually this is becoming real. So I think a lot of the crypto people are just kind of like, okay, this is real, this is here, what are we going to do? How is this going to affect us? They say a controversial proposed rule that would enforce know your customer rules or unhosted or self-hosted crypto wallets, rather on unhosted or self-hosted crypto wallets, may be again under consideration by the U.S. federal government. The rule was first proposed at the end of 2020 by the Financial Crimes Enforcement Network, or FINCEN. That's the U.S. money laundering watchdog. If enacted, crypto exchanges would be required to collect names and homes addresses, among other personal details, from anyone hoping to transfer cryptocurrencies to their own private wallets. Now, I guess with that said, a lot of the major exchanges already do that. They already have KYC or AML. I know when I signed up for Coinbase or FTX or Gemini, part of the process, I think one of them required me to scan my face. The other one required me to take pictures of my license and, a bill, and then send that in so they could actually know who was behind the particular exchange account. I guess due in large part for this, but I guess therein lies the extinction where you have certain decentralized exchanges, like I guess, for example, DYDX, that still operate within the United States jurisdiction, but because they're DeFi, don't require that level of KYC or AML. So I guess that's one of the major distinctions that we can see here. But continuing on, they say industry advocates said that they were concerned that the rules might be impossible for certain wallets to comply with because they are not controlled by people and therefore are not tied to this personal information. The rule was driven by then Treasury Secretary Steve Mnuchin rather than FinCEN itself. The original proposal was published on the Treasury's website and not FinCEN's. The watchdog only posted the proposed rule when the comment period was extended. The Treasury Department, which is now overseen by Secretary Janet Yellen, revealed that the rule might be considered in this semi-annual agenda of regulations, set to be formally published in the Federal Register on January 31st. And that's today. The agenda outlines priorities for the Treasury Department, but it does not indicate that the rule will be for sure implemented or that they will be implemented as is. Rather, the agenda is a tool that signals things the Treasury will work on over the next 6 months. Quote, FinCEN is proposing to amend the regulations implementing the Bank Secrecy Act, or the BSA, to require banks and money service businesses, MSBs, to submit reports, keep records, and verify the identity of customers in relation to transactions involving convertible virtual currencies, known as CVCs, or digital assets with legal tender status, quote, legal tender digital assets, or LTDAs, held in unhosted wallets or held in wallets in a jurisdiction identified by FinCEN, the document said. Continuing on, they say, the proposed rule originally had an unusually short 15-day comment period, harkening back to that earlier point about the comment periods. An unusually short 15-day comment period, further stirring controversy among industry advocates. Typically, the comment periods are between 30 and 90 days, though some rules may have a 120-day comment period. In public notes, FinCEN twice extended the comment period, first for another 15 days and later for a further 60 days. In that first extension, FinCEN treated the rule's provisions as two separate issues. One of these provisions sought to impose currency transaction reports, CTR rules, on crypto transactions to unhosted wallets. Financial institutions currently file CTRs for customers who transact with over $10,000 in a single day. The personal data rule, referred to as the counterparty data collection rule, would apply to customers transferring over $3,000 in crypto per day to private wallets. It is the second rule which led to industry backlash, including several thousand comments filed as a response. The Federal Reserve and FinCEN also plan to clarify the meaning of, quote, money under the Bank Secrecy Acts as it pertains to digital assets, ensuring that digital asset transactions are subject to the same Bank Secrecy Act rules that their fiat counterparts might be. Quote, the agencies intend that the revised proposal will ensure that the rules apply to domestic and cross-border transactions involving convertible virtual currency, which is a medium of exchange, such as cryptocurrency, that either has an equivalent value as currency or acts as a substitute for currency but lacks legal tender status, the document said. Further, the BSA rules will also apply to any digital asset transactions that, quote, have legal tender status, the document said. So I think that that's all pretty interesting. You know, as we can see here, it's another one of these examples of the government just furthering along this torrent of regulation, trying to pretty much put all of these crypto and digital assets under its control, and essentially trying to have its cake and eat it too. They'll classify crypto as a commodity or property for the purpose of taxes, but at the same time try to treat it like fiat or money. So even though you wouldn't be taxed on money in the same way you would be capital gains, they want to treat it for the purpose of tracking it in the same way. So it's one of those examples of, trying to have their cake and eat it too. But ultimately, the government's going to do what it wants to do. So moving on, we could see here is a Chainalysis report that touches on this proposed rule. And they say, our blockchain data shows 3 clear trends related to unhosted wallets that all suggest their primary uses by individuals and organizations are to either store their cryptocurrency for investment purposes or move it between regulated trading venues. So this kind of serves as a counter to the government's narrative for why they really want to push this rule with the KYC, AML, and all these other requirements that it would call for. They are proposing that under the guise that it would help stop terrorism and help, keep track of illicit funds and money laundering purposes. But as we can see here, the on-chain data clearly states that, the main purpose for these unhosted wallets is for either investments or moving between regulated trading. So continuing on, they say, first, the vast majority of Bitcoin sent between unhosted wallets is sourced from virtual asset service providers, or VASPs, primarily exchanges. In Q2 of 2020, 79% of Bitcoin sent from one unhosted wallet to another unhosted wallet originally came from an exchange in a regulated environment. Law enforcement and regulators can therefore usually trace suspicious activity involving unhosted wallets back to regulated exchanges, regardless of how many times the funds passed through unhosted wallets. Only about 5% of Bitcoin sent to unhosted wallets came from risky services or an illicit source. Second, the vast majority of Bitcoin sent between non-VASPs is later sent on to VASPs. So at some point, it's processed through one of these traditionally centralized exchanges or highly regulated sources. While 29% of Bitcoin sent between unhosted wallets was not sent to a service, possibly to hold as an investment, as discussed further below, 62% was sent to regulated exchanges and only 3% was sent to risky or illicit services. The vast majority of Bitcoin, both sent and received by unhosted wallets, has an exchange in a regulated environment as the counterparty, with the resources to help law enforcement. Finally, the transaction activity of Bitcoin held in unhosted wallets strongly suggests that its primary use is as an investment. It continues on and states, our data shows that there are not 2 separate cryptocurrency ecosystems, with one made up of legitimate transactions between exchanges and the other with illicit transactions among unhosted wallets. Our case studies demonstrate this. Law enforcement has used Chainalysis tools in successful prosecutions, seizures, and forfeitures totaling over $1.5 billion in 2020 alone. The current system is working, both in the U.S. and internationally, and efforts to improve enforcement should be driven by what would actually improve the effectiveness of the system, not by adding box-checking compliance requirements. So as we could see, clearly the system seems to be working as it currently is. We don't really need to make it more burdensome by, imposing all of these really unnecessary compliance requirements that could be costly and just create an unnecessary burden on all parties involved. If the government is already using on-chain analysis to track down, seize, and prosecute nefarious activities and funds to the tune of $1.5 billion in 2020, then I think that is it's evidence of a successful use case. So continuing on, we could see what would be required of this rule in order to comply. And there's a few parts, 5 primary parts, namely identification, collection, verification, record keeping, and reporting. as it pertains to identification, they say, first, the proposed rule would require banks and money service businesses, MSBs, including cryptocurrency exchanges, to identify relevant transactions and keep records and/or report these transactions at certain threshold. This includes transactions sending to or receiving from 1. Unhosted wallets, wallets that are controlled by individuals and not organizations, and 2. Covered wallets, wallets that are controlled by financial institutions in foreign jurisdictions on a, quote, foreign jurisdiction list designated by FINCEN as jurisdictions of primary money laundering concern, for example, Burma, Iran, and North Korea. Second, collection. The information that must be collected on the customer and the transactions include the name and address of the customer, the type of virtual currency used in the transaction, the amount of the digital asset in the transaction, the time of the transaction, the assessed value of the transaction in US dollars based on the prevailing exchange rate at the time of the transaction, any payment instructions received from the financial institution's customer, and any form relating to the transaction that is completed or signed by the financial institution's customer. The information that must be collected on the customer's counterparties includes the name and physical address of each counterparty to the transaction of the financial institution's customer. Other counterparty information the Secretary may prescribe as mandatory on the reporting form for transactions, and any other information that uniquely identifies the transaction, the accounts, and, to the extent reasonably available, the parties involved. So, I mean, that's a whole lot of information that they're looking for. Continuing on, one of the other requirement prongs is verification. Banks and MSBs will need to verify the identity of their customers for obligated transactions that exceed the following thresholds. 1. Deposits and withdrawals greater than $3,000. And 2. Deposits and withdrawals involving one or multiple transactions that aggregate to more than $10,000 within a 24-hour period. The next prong is record keeping. Banks and MSBs will need to keep records of a customer's obligated transaction and counterparty, including the verified identity of their customer for 5 years if the transaction is greater than $3,000. And the last prong is reporting. If an obligated transaction or series of transactions in a 24-hour period is more than $10,000, banks and MSBs will need to file a currency transaction report, or CTR, on the customer's transaction and counterparty, including the verified identity of the customer and their unverified name of the customer's counterparty and the counterparty's physical address. So all in all, as we could see, that is a lot of information and a lot that is involved in the compliance. And, ultimately down here, what that results in is an increased cost of the compliance. And I think one of the buried leads is that, who is this cost going to be passed on to? And it's ultimately going to be you and me, the retail customer. We could probably see that manifest itself in higher trading fees. That there is a loss of privacy concern. Just look at all of these different requirements. This is a lot that they're asking for. But I guess with that said, I think it's interesting to really unpack all this and kind of see what it means, just the basis of what the government is seeking to do here and the potential effects that this would have on the industry as a whole. So with that said, I hope you guys liked this comment. All the links are going to be posted down in the description below. If you like this content, please hit the like button. Please also subscribe to our channel. We would really appreciate that. You guys can also follow us on Twitter if you'd like to. We post interesting news and updates on there. Our handle is @CryptoBitLaw. And with that said, thanks again for watching, and we'll see you guys next time.